All right. Hey there, Jesse Harris, CFP, partner at Cardinal Hill Wealth Management.
That was a brag.
Oh, of course.
Robert Hill, PhD. Hold on, I've got the glasses for later.
So, Robert, I've got your business card here.
Ooh,
Do you know what it says on it?
this is Robert Hill, PhD.
Yeah.
Oh, the title?
Title.
Uh, I love my title.
I mean, I'm looking at
I
it.
think it's investment coordinator.
Partner
Ah,
slash investment coordinator.
wow.
And I mean, that's what we're going to be talking about today.
Investments. Coordinating, apparently.
I like to catch Robert off guard. He didn't know I was going to do that. And
Well,
so
shaken
just
up,
like to get a little authentic chuckle out of him for you guys.
Because most of the time it's totally fake. Yeah.
He said it, not me, guys.
Oh, man.
All right. So we're going to be talking investment philosophy. I'll chime in a little bit, but Robert's the resident smart guy, so just going to let him talk about it. And I feel like I've talked about it enough in my career where this is your passion, and let's talk about it.
No, that's great. There will be a part of this video where it will get very nerdy, and I will put my glasses on at that part and push them up. So that's the nerd alert. That way, if you're bored out of your mind and you see that, just don't even watch anymore. But no, we've been getting a lot of questions about, what is your investment philosophy? And this is all going to be fairly high level. But, Jesse and I have obviously thought about this for a long time.
Mm-hmm.
I've thought about this since my first job, and I've life insurance company at MetLife. I was mentored by an actuary and had to do all this fancy math to balance assets and liabilities. And so, anyway, everyone has an opinion. Not all of them are good, but here's our opinion. So, first off, big idea. We're a big believer in diversification. That word gets used a lot. For us, there's a lot of reasons for that. In general, when you think about the global economy, the people that generally make the most money are businesses, but it's kind of hard to predict whether they're going to be big ones or small ones, whether they're going to be the kind of boring businesses or the big flashy businesses like Tesla or whatever. It's hard to predict if they're going to be in the United States or a third world country. That's why diversification can kind of buy a little bit of everything. And as long as those businesses aren't super correlated together, then when one does well and another is not doing well, if you keep investing into that, eventually all the things that you're buying low in will work out. There's a lot of math and research behind all of this, and I won't bore you with the details, but in general, we do like to diversify.
Yeah.
Anything you want to add to that?
Yeah, I would just add that Robert made a statement that it will, if you buy low, it'll always come back. Something along those lines. We can't guarantee that's always going to come back.
That's
historically
true.
speaking, it has always come back. Stock market has, the S&P, Russell 2000, things like that. But just to be clear.
Fair. All investing is risk, and in general, risk and return go together. That's why you need a comprehensive financial plan so that we can get to know you more. So that's the first thing, is diversification. The second big idea is the tension or the appreciation, I guess you could say, between both active management and passive investing strategies. So passive, a lot of people have been getting really into index investing over the longest time. I know my intellectual heritage on this idea is the Boglehead. So John Bogle started Vanguard. He kind of brought investing to the masses. Huge fanboy, love it. Recommend his books to everybody.
He is a fanboy.
And the idea of an index fund is you just buy the market, and you don't try to time anything. You don't try to trade. You don't try to do anything, because all information is priced in. The fancy name for that, little bit of a glasses moment here. I'll take them off in a second, but this is called versions of the efficient market hypothesis. And there's weak, semi-strong, and strong. We believe in the semi-strong, mostly, kind of. Anyway, point is, there's parts of the economy, especially United States stocks, where there's a lot of information on these companies. Google, Apple, Tesla, they're covered really heavily. And so maybe in some of those areas, it doesn't pay to have a mutual fund where you're paying an extra expense ratio, because what value are they really going to add? Maybe that's like the argument for a passive strategy. An active manager is going to say, no, I really have better information. We have a unique perspective. There's things that we're experts in this one part of the world's economy, and so you give them their money to access a small cap fund or an emerging markets fund, and and you have an extra fee for that, and maybe they don't even outperform. And so our philosophy is there's places where it pays. Sorry for bumping that. I realize that was probably loud. There's places where it can pay to have an actively managed fund. We personally think that that's where information frictions are higher, places like emerging markets, bonds, and some other areas. And then there's places where it's really hard for an active fund to outperform. Like for us, large cap United States blend stocks. That's tough to outperform. So, anything you want to add there?
Yeah, just quick clarification. Active is a fund manager typically. ETFs are getting where there's some active out there. And passive is really you're just buying a bucket of stocks. No one's managing it. It's just trying to mirror a specific index typically, or it has a specific strategy tied to it.
Yep.
And so,
Yep. Third thing with our investment philosophy, this is not really the theory of how we're designing portfolios. It's just important to us, is the principle of skin in the game. So we invest in our own funds. All of my personal IRAs and everything is here in the model portfolios that we're building. Everyone's circumstances are unique, so it may not be in the exact model portfolio that I have if our risk tolerance and time horizons don't match. But in general, we have our money in our model portfolios, other than some cash reserves in the bank. And we feel like that incentivizes us to really pay attention and to align our interests. Is it perfect? Probably not perfect, but we feel like it's a really good way to try to, yeah, the idea of skin in the game, everybody, I think, intuitively understands that. And we always want to eat our own cooking.
yep.
That's the goal.
And so I'm going to talk briefly on fund selection, how we get where we get to in each space. I won't take too long because this is just something I really like. And Robert and I have had arguments before he was doing this with me. He was a pretty big advocate for passive investing, and I thought that there were places where active could outperform. So we've argued back and forth on that. Part of what makes us a really good team. But in regards to fund selection, in general, we don't want to get a actively managed fund that over the long haul is not outperforming its index. Now, we don't know for certain that it's going to continue to do that, because past performance does not guarantee future performance. But a lot of times we can find good fund managers that have a really good process in place, and we can see a really solid track record over time. And their process is really good to go and find really good stocks. Because our own money is in it, we don't want to be paying more for something that's doing less, right? We want to be making money just like everybody else out there. And so that is where we come up with our different funds as we go through a massive process and find some of the top in the class of that category. And then we see if we want to own it and if our parents would want to own it and things like that. But that's how we find them, is we go for a long track record, tenured manager, and good performance.
Mm-hmm. Yep. Next principle, you're over halfway there, so hang in if you're still watching. There's a tension a little bit between these two ideas. On one hand, we are not market timers. I would love to perpetually string together, accurate predictions on buying low and selling high, and buying low and selling high, and buying low and selling high. That would feel amazing. It's really hard to do. The economy is extremely complex. The way that people, stock prices don't always follow exactly in fundamental valuations of businesses. There's things that it's really tough to predict. I won't quote the statistic, but there's something like if you miss out on the 10 best days of the market, you lose a significant amount of the returns over a long holding period. So just think about that. Just when can you predict when there's going to be a big day? So if you're in cash because you're afraid of what the economy is going to do and you miss one of those big days, that can evaporate a lot of the rest of the work your portfolio has done the rest of the year. So on one hand, that terrifies us to be out of the market. On the other hand, we are actively monitoring the economy and what sectors of the economy are doing, and we're very responsive. We really like to understand everything that's going on. We subscribe to a lot of different research software packages. We're always talking to people, getting people to review our portfolio. And so we are not just going to check our brains at the door and not follow what's going on, but we would hesitate to go 100% cash because we haven't predicted right this time. That's just really scary to do because what if you miss out? So anything
Yeah, I
to
mean,
add there?
I think good thing to clarify there is we're not market timers, we're investors, and
Mm,
investors have a mindset of we're in it for the long haul to make money. Does that mean we're going to buy and hold something just completely with no brain work? Well, absolutely not. We're going to always be monitoring, and I think that was key what you said. We're just always
yeah,
monitoring what's going on, not just in the market and economies, but also with the specific funds that we own. We're always
exactly.
monitoring them.
Definitely. Um, okay, and then the last, this is where I get really nerdy, so nerd alert. Okay, in terms of how we incorporate academic research into our portfolio construction process, there's a number of disciplines that we use. Um, so obviously with Jesse's background, that's going to be built more on the discipline of finance, so which is a business discipline. Big ideas here that there's so much to say here, but the big ideas here is one is the notion of an efficient frontier. And so risk and return, kind of go together. So you want to design maybe, or it's hard to predict in the future, but you want to look back and see what would be a good stock to bond ratio, for example, that would give you the most returns for the minimal amount of risk. You're never going to know what it's going to be. You can do some math and say this is what it was, um, and that's difficult, but that gives us an appreciation for why we personally may always want to hold a little bit of bonds just because they can be non-correlated. It's so if you had, for example, a 100% stock portfolio versus a 90% stock portfolio with 10% bonds, there's ways to get longer risk adjusted returns from that portfolio potentially than the 100% stock portfolio. So it's the idea of appreciating the way risk and return go together. And then another one is just, going deep into the research of, you know, past Nobel Prize winners. So Eugene Fama and Kenneth French, really respect their work. Three-factor model, which gave birth to the five-factor model, which shows us that maybe instead of just being totally obsessed with large cap stocks growth, which is totally in vogue right now, maybe we should also appreciate small companies that aren't valued very richly. That maybe in the long term there could be some value there. So that's within finance literature. Lots of stuff that we've already said comes out of that literature as well. The math behind diversification. The other stuff, though, so my doctorate's in business strategy, which I feel is a great discipline because it appreciates things that are only now being really appreciated, in my opinion, by disciplines like economics and finance. And the first is behavior, so human behavior. For a long time, strategy research has appreciated, hey, look, a CEO is a human being. He's not just a robot that perfectly predicts everything and perfectly adjusts the firm based on some calculus or algorithm. There's politics in a corporation, there's emotion, there's ego, there's all
Yeah.
this stuff that factors in, and so that's really important. And it's related to the discipline of psychology, which is important to consider not only for the investor. There's a lot of wonderful behavioral finance research out there about people's loss aversion or their hesitation to double down on a stock that's going down because of loss aversion and things like that. But that also influences CEOs and executive teams and the performance of big companies that you may be following. I'm not going to insert any names of companies here, but you just think top of mind of some billionaires that are in the news regularly. You may see some illogical behavior, and so we try to factor that all in to how are our clients feeling, what are they going to experience in different market conditions and different phases of their life, but also looking at parts of the economy. Something that may be happening with domestic technology, with AI stocks and the valuations of those companies. It may not be perfectly logical in our opinion, and that's where some of that other academic literature can come in to help explain what's going on and help us kind of stay the course. So I'm going to take my glasses off now. Sorry if that was super boring, but
No, it's great. I
it's
think
part
it's
of the thought process.
well, I think it's important to think about those things, and I'll end with this: into the behavioral finance side of the equation. It's really important that you have somebody, even if it's yourself doing your own investing, that you understand how you work and what you're trying to achieve. because that will be a great determinant and predictor of how you should be investing and how much risk you should be taking. And so that's why we're big proponents of what we do. We like to help people figure out who they are, what they're going for, what passions and dreams they have. And then we like to build a plan of investing around those things. We don't just invest because we want to make a lot of money. That's part of it, is making money to help solve some problems and goals and dreams. But really, we want people to be as what is this, National Guard? Be all you can be. G.I. Joe's?
Army?
Maybe something like
Be
that.
all
But
you
yeah, we
can
just want
be,
people
join
really
the
to go for it.
army.
And so we plan first and invest second. But I'm drinking a wonderful Kirkland
Ooh.
grapefruit fruit sparkling water.
Mmm.
Cheers,
Delicious.
my friend.
They're tasty pieces.
They are.